Good morning.
Hey, good morning, everybody. Hey, Ned, how are you?
Could be better. Could be
Yeah,
better. We've lost our captain, but you somehow will struggle through.
yeah. Yeah, all right. So I'm Dean Croak here, sitting in for Ken Adamo today. I'm the market analyst here at DAT Analytics, joined by Ned Damon, as always. He's our principal data scientist. Ned, I was talking about you last night. We've got a lot of smoke haze over here on the East Coast, and they tell me that the jet stream's bringing it from over your way. Is that correct?
I believe so. It's fires in Southern Oregon, though. So due to the nature of the weather patterns, we're spared most of it, and you guys just get to have bright red sunrises and sunsets.
Wow. Well, we had the Sahara dust storm last week coming across the Atlantic. This week it's smoke coming across from you. They expect it to last midweek, but we'll talk about weather a little bit later in the show when we talk about our DATIQ question of the week. So for those new to the program, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific. We talk about trends in the freight market and what to maybe look out for, but most importantly, to answer your questions. So please feel free to drop them in the chat box below. We'll answer them towards the end of the program once we get through our market update and forecast. Just a reminder, though, they tend to pile up towards the end, so get your questions in early. We've got a crew in the background working to get them over to us as quick as possible. That way, there's a better chance they'll get read on the air. So with that, we'll dive into the market update and some of the key trends. As always, some of the items we'll cover today are in our DAT weekly market update that gets published on Wednesdays. Some of the key points we're watching this week, spot rates dipped slightly on higher volumes last week, not surprising for this time of the year. Spot rates dropped below contract rates, though, in van and flatbed. That's an interesting turn. Contract rates are continuing to climb, though. Refrigerated spot rates are still up 28 cents a mile over contract, though. But again, not unseasonal. Typically, we see higher spot rates in reefer this time of the year. The quarterly index from the US Bank was out last week, showed shipments were up 6.8% year over year. So that's quarter two versus quarter two last year. But spending was up an amazing 44% year over year due to the high freight rates that we're all experiencing in the market. The other news that we're watching closely is capacity on the West Coast. Last week, Union Pacific halted their intermodal services from Los Angeles to Chicago. Essentially, that means trains running between Ontario and Joliet, Illinois. They shut it down due to excessive congestion, so that pushed a lot of volume over into the truckload market. We'll talk about that a little bit later, and it pushed up freight rates on that lane. That's a pretty significant lane. About 30% of all intermodal moves on that one lane between Los Angeles and Chicago. All right, so diving into the load board activity, we're having a look at the dry van section first. Load post volumes increased again last week, up 6%, but there was no change in equipment post numbers. So as a result, the load to truck ratio increased by just under 7% to 5.93 loads per truck. In the refrigerated sector, spot market volumes increased another 3% last week, still down 12% over the last month, though. Again, this is in line with what we'd normally see post-July 4th, so nothing alarming there. 7% fewer equipment posts compared to the prior week. As a result, the load to truck ratio moved up 11% to 12.83. In the flatbed sector, load post volumes increased by 2% last week. And even though volumes are up about 48% compared to the same week last year, they're still down 20% in the last month. So the trend is more downwards at the moment over the longer term. Capacity did tighten, though. There was 4% decrease in equipment posts. As a result, the load to truck ratio moved up last week to 44.57. Diving into the market condition index across the country, a couple of markets we're watching today. The San Pedro Port Complex, home to ports of Los Angeles and Long Beach. Typically about a third of containers arrive in that particular port region over the course of a month. There was a big uptick in the number of ships going to anchor in the last 6 to 7 weeks. There were 30 container ships at anchor last Friday, according to Kip Lowther from the Marine Exchange. That dropped down to 21 yesterday, but the spike at 30 ships waiting at anchor last Friday, that was up 11 from mid-June, and it was the highest we'd seen since March 6. And that's important because import volumes are continuing to climb. That's pushing a lot more volume into the spot market. Last week, load post volumes were up 3% last week and up 14% over the last 2 weeks. Those two numbers track very closely, import containers and load post volumes in Los Angeles. Having a look at the Port of Los Angeles Signal Report, which forecasts volumes in the coming weeks, they're expecting a 44% week over week increase next week. that'll put container volumes up 45% year over year. So the 44% increase they're expecting next week in the number of containers is basically a forecast of what's either at anchor or what's on the ocean heading towards Los Angeles now. The other thing that happened on the West Coast was, of course, the Union Pacific announcement. That was an emergency measure to get thousands of ocean containers moved for cargo owners. This is one of the heaviest lanes. As a result of the closure, we saw a correlation between our spot rates and the shutdown on the intermodal side for UP. Spot rates surged last week to a 12-month high of $2.90, excluding fuel. That's up 23 cents a mile, higher than the average recorded in June. So it'll take a week or so for that to clear on the intermodal side. So we're looking for higher volumes out of the West Coast as a result. In the refrigerated market condition index, having a look at a couple of markets this week, the short 8-week cantaloupe season in southern Missouri starts. There was a shortage of trucks last week. Rates hit a 12-month high of $4.24, excluding fuel. So it's an average of $4.24 to all destinations. That's $1.19 or 37% higher than the same time last year. It's a really good indication of how tight capacity is on individual lanes like this one. Further west in Colorado, in the San Luis Valley, that's home to a lot of potato production. Colorado is the second largest fresh potato region in the country. It's about 1.5 miles above sea level. Shortage of trucks last week. Rates in that market jumped. So in the Grand Junction market, where spot rates jumped 11% to an average of $2.40. So if we look at our DAT map there, you can see Grand Junction is just below the Denver, Colorado market. So rates are up 11% week over week. From San Luis to Chicago, loads of potatoes hit $2.62 last week. That's up 60 cents a mile from this time last year. And on the 1,500-mile run east to Atlanta, spot rates surged to $2.57 a mile last week. Reefer rates were up the most, though, on the San Luis Valley to Philadelphia run. They reached an average of $2.76 a mile last week. So having a look at the flatbed sector, I took a look this week at the Baker Hughes rig count. That's an important business barometer for the drilling industry and its suppliers. The number of rigs drilling for oil has almost doubled in the last year, and that's driving a lot of flatbed volume out of Houston for things like drill pipe, casing, and machinery. Loads from Houston to Oklahoma City, they're up $1.50 a mile to an average of $3.48. Compared to this time last year. Bismarck, North Dakota, home to the Bacon oil field, spot rates spiked last week to an average of $3.26. And loads west from Houston to Lubbock in the Permian Basin oil field leveled off at $3.31 a mile last week, but they're up $1.60 compared to the same time last year. So wrapping up our weekly market update with our year-over-year look at spot rates, more seasonality last week. Rates appear to be sliding sideways rather than dropping. But that's pretty traditional in the post-July 4 period. Maybe we see a little bit of a steeper drop-off after July 4. This week, more sliding sideways. Decreased by less than 1 cent a mile in dry van to $2.41, excluding fuel. That's 3 weeks in a row spot rates have been moving sideways, still 56 cents a mile higher than this time last year. And in the refrigerated sector, rates dropped 5 cents a mile in the prior 2 weeks. To last week, dropped 3 cents a mile last week. So they're definitely moving down to an average of $2.73 last week, excluding fuel. Still 65 cents a mile higher than this time last year. And wrapping up with flatbed, flatbed rates dropped another 2 cents a mile last week to an average of $2.69, excluding fuel. That's the 3rd week in a row spot rates have been moving down in flatbed, still 66 cents a mile higher than the same week last year, and 22 cents a mile higher than the benchmark year of 2018 when we had our last tight capacity cycle. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly market report. Over to you, Ned, for the short-term forecast.
Howdy, everybody. We're going to be starting off with our dry van forecast. In blue, you can see the market rate observed by DAT, and then off to the right, you can see our strands of spaghetti that correspond to our different forecast methodologies. In red, you can see our short-term forecast, or it's a little hard to see, but it's there. It's expecting the rates will continue to slide maybe by about 3-4 cents a mile heading into the later part of August. The ratecast model is expecting the sideways slide to continue with a little bit of uptick at the very tippy end of August, maybe by 2 cents a mile. And then our blended forecasts in gold and silver are leaning much more towards the short-term forecast here. The blended forecasts are mixtures of the ratecast and the short-term forecast in different ways and in different amounts. And they both feel that the short-term forecast is going a little bit more truthy, I suppose. But we'll see how that shakes out. There's still a lot of model agreement in van. Moving forward to reefer, once again, you can see the market rate observed by DAT in blue. And then once more, there's pretty broad model agreement. You can see the short term in red, the rate cast in green, basically completely lining up, and the two blended forecasts in gold and silver, more or less lining up with the silver forecast trending a little bit down. You can see that there's an expectation of flat with a little bit up heading into August, the later part of August, although we have that one minority outlier that is suggesting that maybe things will be a little bit less stable. Finally, move into flatbed, which is where we see some real model disagreement. In blue, you can see the market rate observed by DAT, and then off to the right, you can see our forecasts. Basically, all forecasts are in agreement that the rate is going to continue to slide, but the question is how much and how dramatically. Rate cast in green is expecting a more or less flat for a little bit, and then a drop by about 4 cents a mile heading into the later part of August, whereas the short term is expecting just a pretty steep drop heading into August, maybe about 15, 20 cents a mile. And the short-term forecasts are leaning a little bit more towards the short term. So it'll be interesting to see what comes of it. And that is it for the forecasts. And so it's time for our IQ question of the week, which I have in my notes. It is, how will extreme weather patterns across the United States impact freight? Dean, how will extreme weather patterns across the United States impact freight? Dean? Oh no, we've lost Dean. Okay, all right. Well, geez, it's dropped. Folks are dropping like flies. But as far as how extreme weather patterns are going to impact flight rate, I would really feel more comfortable if Dean led the discussion as our principal industry analyst. So we'll just bear with us a moment while we recover. And one moment. Sorry, I would fill the air better. There's Dean. Okay. All right. Okay. We're back. All right, Dean. How will extreme weather patterns across the U.S. impact freight? Safety, Dean. I don't want to be alone.
I'd love to be able to say the hot weather here in Massachusetts has affected our internet connection, but I don't think that will fly. But we were talking about this yesterday, Ned, that we've had some excessive weather patterns in the last couple of weeks. If you think about what's been happening on a global basis, we've seen extreme flooding in China that's impacted the supply of iPhones. Apparently, half of the iPhones are made in that one area last week. I think it was Zhenzhou where they had the 25-inch annual rainfall fell in one day. And they had something like 8 inches in an hour. And of course, now we've had the really bad floods in Europe, in particular Germany. It's washed away a lot of rail lines. So now supply chain disruptions are starting to be affected again by weather this time, which is going to impact the ocean carriers. Here in the US, though, we've got the point that I think I wanted to make before we sort of dive into the rate aspect and the volume aspect. We've got according to the forecasters, we've got a heat dome building that's going to start to set up over this week over much of America, particularly from the West Coast all the way through the Central Plains. So that's going to stretch our resources even further. Forecasters think, and this is why it's an important question, forecasters think this could last well into August. And, we're talking about triple-digit temps, 5 to 10 degrees above average. This excessive heat plays on freight markets. I think it's going to impact refrigerated spot rates because there'll be more volume moving in refrigerated because of the excessive heats in some of these areas. Dry vans build up a lot of heat internally for freight that might be a little bit more sensitive. I think there's a couple of things I would like to just send out some messages to carriers, shippers, and brokers. Hot temperatures like this expose all of your weaknesses. On the equipment side, mostly, you've got to make sure your tire pressures are correct, make sure your dual tires are matched. You've got to reduce your cruising speed. Drivers have got to really slow down when it gets hot like this. On the blacktop, it can be 10 to 15 degrees higher than what ambient is. It will peel in particular recap tires off trailers in a heartbeat. Carriers in the refrigerated space, you've got to make sure your radiator cores, even on the truck, hose them out with a hose, not a pressure washer. Make sure your radio and intercooler cores are clean. Make sure your refrigerants are topped up. Make sure your pulley belts are in good shape. No leaks in water pumps. Now would be the time before this hot weather period sets up to go through and check all of your equipment. Even if you don't have an A, B, or C service scheduled, now would be a good time to do it. And drivers, please. Drivers make this mistake a lot. Please be careful not to dehydrate. Be doubly sure to be hydrated before you exit the air-conditioned cab. That's a really important tip. Sometimes you wait until you're thirsty. That means you're already dehydrated. So take care out there, guys. That's on the equipment and the driver side. But I think what we're going to see, Ned, is an impact on the freight side. Equipment does slow down. Drivers do slow down. Traffic conditions get worse. But I'm interested to get your thoughts on what you think might set up for spot rates more in the refrigerated sector than anything.
I mean, there's going to be increased demand for refrigerated equipment, and so you'd expect that refrigerated equipment would increase. You have this issue of, as you said, the throughput is going to go down. I mean, one of the things that I found really interesting about this last year, well, in addition to everything else, is that every time that we're in a seasonal pattern that's kind of tending us more towards reduced rates, there's some big weather event that kicks things up. So I'm thinking back in the early part of the year when we have the normal post-holiday slump, the polar vortex kicked rates back up.
Yep.
And here I expect you're going to see probably a similar thing. There might be some siphoning of van capacity into reefer for loads that aren't normally temperature controlled, needing to be temperature controlled.
Yep.
But I think overall, just the supply chains are so goofy that it's like this kind of sustained disruption to things can be really, really hard and make everybody just out of sorts. And the only way to kind of lubricate over that is just either with more man hours or more money.
Yeah. Well, we saw the polar vortex have an impact that really upset the freight market, and it took weeks, if not months, for that to work its way out of the system. Then we had Road Check Week. I used the analogy last week on the Sirius Radio Show on Radio Nemo of an elastic band that's fully stretched. And if you have something like that fully stretched, it doesn't take much more to make it snap. And to me, that feels like what the truckload market has been like, certainly for the last 6 months. Drivers have been running pretty hard for the last 6 months in particular, maybe the last 12 months if we go back far enough. Capacity is still tight. Not enough drivers are coming online. We've got increasing demand in a number of sectors. So I think the point is it doesn't take much for this market to become, the capacity situation is sort of becoming an acute capacity crunch. The other point that I think is worth mentioning is we're deep into hurricane season. We've always got that on the forefront of our mind when we think about the South and the impact that hurricanes can have from now through November. But the other thing people need to keep in mind is in August, next month, only I think it's 4 weeks away, we've got Brake Safety Week. And Brake Safety Week is another road check type week that's going to exacerbate the capacity problem. The expectation is that carriers will take more time off to avoid the inspection process and the downtime. So I think we're in for some disruption in the next 2 to 3 months, that it won't take much to upset what looks like a downward trend in spot rates, although I'm cautious to call it a trend because it looks more like a slide sideways than anything. So it won't take much for spot rates to take off again if we see some sort of massive market disruption like we'll see with this heat dome setting up that could last weeks leading into Brake Safety Week. A lot of people have asked, why is Brake Safety Week different than Driver Safety Week last week? Well, Driver Safety Week last week was a mobile speed inspection process. So it's just like troopers out on the road monitoring speed. The International Road Check Week in May and the Brake Safety Week in August are static inspection points at locations across the country where you can get pulled in and spend hours and hours being inspected. The three things are very different when you look at the types of things each event are doing. That's why we didn't see any impact of last week's Driver Safety Week. It was pretty much a non-event on a capacity perspective. I think August is going to be quite a tumultuous month if some of these weather patterns play out and we see the impact of Brake Safety Week later in August.
Yeah, one thing I also want to talk to is this idea of hysteresis, where to the rubber band analogy, like if you stretch out a rubber band and you keep it stretched out, even if it doesn't break, like it locks in that change. And I think the fact that we're starting to see contract rates shifting up to be spot rates, like it takes a longer time for these things to go back to normal. And so we're sort of locking in a lot of ways, higher prices into the future. Same thing with driver pay increases. Like you can't claw those back, and you wouldn't want to.
Right.
So
let's dive into our questions of the week.
Yes.
What have we got there, Ned?
What impact will Delta have as it relates to shutdowns at places like LA Long Beach, from David Matheson?
Delta.
The Delta variant of COVID.
Yes. I've been wondering, I think we'll see a similar effect. I don't know that we'll see as much of a drop in productivity as we saw last year. It'll certainly slow down or exacerbate some of the delays we've seen at docks in particular, where we've got manpower shortages and additional safety protocols in place in terms of physical distancing and electronic documentation versus a physical exchange of paper documents.
We have a question from, I want to get this name right, Nurfad Nadorarevic. When we get a few tornadoes and hurricanes deep, these rates will skyrocket all over the place. Carriers are essentially using any excuse in the book to raise rates higher. I don't think that's really like a fair characterization, but I think that rates are raising. I think that there are real physical reasons why rates are going up, and it's not just, carriers are asking for more money. I mean, they ought to get it.
Yeah, I think there definitely will be some rate volatility around things like tornadoes and hurricanes. That happens every single year on particular lanes. In the setup of the FEMA emergency supplies into the staging areas, which are typically 4 to 5 hours out from landfall, you'll see that sort of van positioning of both loads and equipment ahead of time, and then you'll see the goods coming in afterwards. I don't think that'll change this year. They are forecasting an above average season of 5 to 6 storms making landfall. But we haven't seen any evidence yet that that's going to happen, because we're only probably a third of the way into the season. I wouldn't agree necessarily that carriers are using essentially any excuses in the book to raise. This is how the market works. It was only 15 months ago carriers were protesting in Washington about $1 per mile rates. So if you even it out over time, I think it kind of does even out over time for carriers in particular. I know that's the case on some lanes that I've run my equipment. Sometimes you've got to take a pretty low rate because there's low volume. It's essentially a backhaul market, but you've got to reposition your assets. You look at a lot of lanes now where there's the lanes are sort of disconnected. They sort of uncouple themselves, particularly on things like Los Angeles, Seattle, Los Angeles. Your head haul rate's always much higher than your backhaul rate because of the volume imbalance. That's just how the market works. So I think the answer to the question, the first part of the question, is yes, there will be impact this year, especially while ever the market capacity remains very tight like it is now. It won't take much for the market to increase spot rates.
Yeah.
All right.
I think that's it for the questions that we've got, unless our producers have any other things to throw in.
Yep. So we have some shout outs this week, Ned. We have our big DATCon conference coming up.
Yes, DATCon.
Very excited.
Yeah.
First week of October, we've got some pretty big guest speakers, some big names, a lot of 3 p.m. tomorrow. And as always, I'll be on the Landline Now show on Wednesday evenings talking with Terry Scruton.
I'm sorry, Dean, you're going to have to repeat a little bit of the plug for DATCon because we got cut out.
Oh, it wasn't a very good plug, Ned. So.
It's dat.com/DATCon to go for all your DATCon information and needs. And then do you want to repeat that plug for your radio?
Sure. I'll be on SiriusXM Road Dog 146 at 3 p.m. Eastern tomorrow on the Mark Willis radio show. We're shouting out some flatbed carriers, essentially giving some love to the flatbed carriers this week. They don't get a lot of attention over the course of the year. So it's kind of flatbed carrier week on Sirius XM this week. And as always, I'll be on the Landline Now show tomorrow evening with Terry Scruton.
All right. I think
All
that's
right.
it.
That's it.
Yeah.
So that's it for the show this week. Happy to have everybody on. If everybody could, if they've got any questions that we didn't get covered today, shoot us an email at askiq@dat.com. That's askiq@dat.com. That email hits all of our... What happened there?
It got cut. We ended her. Oh, no, we're back. We're live again. All right. AskIQ@DAT.com. Send your questions there. It's a week. It's been a week. All right.
Okay. All right. Well, we got through it. That's the main thing.
That's the main thing. All right. Bye, everybody. We'll see you next week.
Oh, man.